it, the closing bell at the New York Stock Exchange signaling the end of the first trading day of the week. The Dow Jones kicked off the week in the red. It closed out the day down over 660 points. The S&P and NASDAQ also fell today. The S&P is down over 3%. It is the first time the index has fallen below 4,000 in over a year. The tech-heavy NASDAQ suffered losses as well, dropping more than 4%. So let's bring in Rod von Lipsey now for more. He's the managing director at UBS Private Wealth Management. Rod, welcome. Thanks so much for joining us. So what was driving the market down today?
Tanya, great to be here with you today. Wow, what a day. Today, the buyers were on strike in the markets. And we saw some trouble this morning when we opened up with the 10-year Treasury up above 3.1%. That kind of spooked the markets and started things down, and they never really caught up, except maybe a little bit of a short squeeze at the end. One of the things that we have been seeing and hearing from the floor is that there's not a whole lot of volume out there. Again, I mentioned the buyers are on strike, but it's like they're trying to trade on air. And so that means that any trade out there can disproportionately move the market. And from the institutional level, we're just not seeing any support. No one seems to have the conviction to step in and buy right now. So today's action was pretty much a downhill slope all the way.
Really interesting. Let's dive into now tech for a moment, because, as you know, big tech companies experienced significant growth during the pandemic when the world went remote. Why are we seeing tech stocks take such a hit following the Fed's latest interest rate hike?
Tanya, I think there are a couple of things going on. First of all, you just mentioned that point about interest rates. And so there was a point where we used to be saying, Tina, there is no alternative to equities. And recently, because bond rates are up and on the short end as well as on the long end, we're now starting to see investment grade bonds provide yields that some investors are believing that there is some alternative to owning stocks. And so that hasn't been helpful for the tech stocks. The other thing that we're seeing is that much of the COVID bonus, if you will, the stimulus that we got during COVID and much of that support, that's really been pricing out of technology stocks. It's almost as if we went back and said, we're going to take all of those earnings that were pushed forward by all of us consuming technology and buying lots of goods, and we're going to discount those back to where they were and start from scratch. And that's what we're starting to see in some of these technology stocks and some of the technology names, is a repricing or an elimination of that COVID premium.
Really interesting. And Rod, the April Consumer Price Index, as you know, is set to be released later this week. Interestingly, we've continued to see strong consumer spending despite inflation. But I'm curious what you think about inflation. Do you think it's peaked now? Do you expect the Federal Reserve's expected hikes will be necessary to lower the cost of everyday consumer goods nationwide? And do you think consumer spending is going to continue on this tear?
Well, listen, we have to hope that in March, we saw peak inflation, peaking out there at 8.5%, as you mentioned. And we're thinking that we'll see the April numbers come out, the CPI this Wednesday, showing that things are starting to cool off a little bit. And so that's having the desired effect. We're slowing down. The inflation of prices and the inflation on assets and things like home prices, because those interest rates are going up, we're starting to see that chill. There's an old saying that says, don't fight the Fed. And I'm not going to second guess the Fed. I think that they understand what they're doing and that they're starting to get some of the desired results. We know we'll have another 50 basis points coming up in June. And between that and what we're seeing in the markets, this natural rotation, we may be seeing ourselves setting up for an inflationary condition, but not the recession and the other things that we're hearing the naysayers talk about.
Right. So you think that this will have the desired effect? You think that these hikes are going to cool the market down to the place where inflation will start to come down, some of these supply chain issues will slowly go away?
Tanya, that's our hope. Mm-hmm. Now, they say hope is not a strategy. And so we have been positioning our investors and positioning our clients for making sure that we're ready to deal with inflation. But again, we are not seeing indications out there that would tell us that we should be worried about a recession at this point in time. And I think that's a really important distinction to make.
Yeah, that is a very important point. Rod von Lipsey, Managing Director at UBS Wealth Management, thank you so much for joining us. We appreciate your insight.
Glad to be here.